Hello, I'm here to make a video for chapter 3 for fund accounting. And so this will be for the beginning of week 2. I hope you guys are all doing well. Let me go ahead and pull up can you shut my door? Let me pull up the blank notes and I will go through them with you. I hope you guys are all doing well. We only have to do one chapter this week instead of 2, so that's very exciting for you. So I will have the homework solutions posted shortly for chapters 1 and 2. I don't want to post them because I still have 3 people waiting to submit them. And so, because right now it's Sunday evening, it's not Monday morning. So, but I'll make those available on Monday morning first thing. And so let's just do the chapter 3 notes and then I'll make a separate video kind of walking through everything for this week. So, okay, so chapter 3 is our introduction into budgetary accounting and how to do some budgetary journal entries. We've never done budgetary journal entries before, so this is a brand new topic for us. And so first of all, there's a little bit of a conversation in your text about the government-wide statement of activities. This is an income statement and it's for the entire umbrella of government. So expenses are going to be reported first and then revenues. And so that's kind of an interesting dynamic. That's not a normal way to report things. Our expenses are going to be divided up as direct versus indirect. Because some are specific to like a certain program, like the library or whatever, whereas others are just like overall expenses that aren't tied to a specific function. So it's kind of like in managerial accounting when we had direct material and direct labor, but then we had overhead, which is kind of like an indirect. Okay, so for our revenues, we're going to have program revenues, which are specific to a program. So program revenues. And so for program revenues, again, they're like specific for something. Like if it's the water department, it could be a charge for a service. We could get a grant of some kind or a contribution of some kind that's for a specific purpose. The other is general revenues. And so general revenues will be like overall taxes, which will then be used to cover all kinds of things. And so they're not directly tied to a certain program or a certain like grant. It's just overall money that is used to support the entire government. So most of the general revenues goes first into the general fund, which we'll talk about in chapter 4, and then it gets divided or doled out to other people. So it'll come in through the general fund and then we'll like transfer money in and out of the general fund. So our income statement, if you want to look on page 67 of your book, that's where we'll actually see a picture of it. I think I have your book pulled up like an ebook. So I think it's at page 67. So I don't know if that worked or not. I don't know. Go. Okay. So 67. An embedded page, a text. I don't know what that means. Okay. So is this page 67? It's not. Maybe I need to. I wonder if I need to get back in. Now it's going to bother me if I can't figure it out. So now I feel like I have to go find it. So I hate when it tells me that. It tells me that all the time. All right, let's go back. I have an old version of the book saved from forever ago. So, now it wants to work. Okay, so it's on page 67, but clearly that's not the right page. Let's go to the next one. All right, so is that what I'm looking for? Now that I've, okay. A net expense or revenue format is used in the top section of the statement of activities. All right, so here's an example where we first list our expenses over here, and then we have specific program revenue that would be coming in for a certain thing, getting the net revenue or expenses. Usually it's a negative number because usually in the government, they don't charge enough for the program to be able to cover the expenses. And so it's very normal for all of these to be negative. And then we have our general money that comes in to get basically whether we have income or losses. And so, all right, so it looks like instead of page 67, It was on page 69. So the way that it looks is expenses less our program revenues equals our net expense or revenue. And so you'll notice that net expense or revenue in that last column of this, where notice that in the pretend one, like with no numbers, they listed them all as negative because almost always they're all going to be negative. And then from there, that's when you bring in all the general stuff to eventually get to a place where you have a break even-ish section, like the change in net position. And then this is beginning to end. So this is basically a change of revenues, expenditures, basically expenses to kind of show like an income statement. So it's called a statement of activities. So, all right, so extraordinary items and special items and stuff are all going to be listed toward the bottom, just like they do on our income statement. So on our traditional income statement that we do in chapter 4 of Intermediate Accounting 1, we learn about an extraordinary items and discontinued operations. So we did CDE, continuing, discontinued, extraordinary. And so extraordinary items go on the bottom of the income statement, net of taxes. Now, in fund accounting, we don't have to worry about taxes because we're a nonprofit and we don't pay taxes. And so you don't have to do the whole net of tax thing, which is probably a blessing because I know that that wasn't everybody's favorite topic when we were in intermediate accounting, even though I really like it, not everybody else does. So, okay, so let's kind of go through the general fund, because the governmental funds are the ones that are going to report budgetary accounts. And so this is kind of a new thing for us. And so the general fund is the one we're going to focus on exclusively in chapter 4. So next week is a really, really big week for us because we're going to really dig deep into journal entries. So the general fund, the purpose of it, there's only one per government. Okay. Sorry, later. Go to the steps though. Okay. So what we're going to do is we're going to use the general fund to report all of like the general overall stuff, like the police department, fire department, administrative, all that kind of stuff. And so these are some examples of the things that you find in the general fund. And so this is the first time we've ever done budgetary accounting. So budgetary accounting means we're going to actually record a journal entry for the budget. Now, we learned how to do budgets in managerial accounting, and we did lots of budgetary stuff in managerial accounting, but you never did journal entries for the budget. You just had all these giant spreadsheets of budgets, but you did not actually do journal entries for the budget. And so the only time we do journal entries for the budget is in governmental accounting. And the reason is because we have to be super, super careful to not overspend. So we have a certain amount of money per function, and we are not allowed to spend more than those amounts. So we have to make sure that at no given point we spend more than what we have allowed for a certain item. So it's used to record the budgetary inflows and outflows estimated or authorized in the annual budget. So the actual budget gets approved, and then we set aside money saying that this is what we're allowed to spend on travel. So in my department, the part that always annoys the crap out of me is copying. I can't teach a lot of things in accounting without having to make some copies of stuff in my day classes. And it makes me crazy that they're always like, oh, your copy budget, you don't have enough money in it. And I'm like, I just need paper. Just let me have paper. I don't ask for a lot in accounting. All right, so let's go through our actual new budgetary accounts. And so these are actual T accounts, like cash, accounts receivable, supplies, equipment, building. It's an actual T account. And I'll identify balances on each one. So we're going to have an account called estimated revenues. We're going to have an account called estimated other financing sources. So I call it estimated OFS. Okay. So this is our regular revenue, like taxes maybe. And then other financing sources is going to be like an other revenue category, just like in financial accounting. All right, so then we're going to have appropriations. And we're going to spend this whole chapter defining these things. And so I'm not going to go into a whole lot of detail about exactly what they are, but I am going to walk through them a little bit. And then I'll talk about exactly what they are in the next pages. So after appropriations would be estimated other financing uses. So this would be like estimated OFU. Okay, so only one U, like other Friends University. Yeah. Okay, so estimated OFU. So this is OFS and OFU. So this would be like our regular expenses, and this is other expenses. So usually the things that we see in OFS and OFU are either like grants coming in, that's a common OFS. And then for OFU, a lot of times it's money transferred out to other departments. And so it's not an expense because you're just transferring money to another place. So that'll be a very common OFU we see. Appropriations are the budgetary expenses. So wouldn't it be nice if we said estimated revenues and we just said estimated expenditures? But no, we call them appropriations because we're fancy. Okay, so down here, our last one is encumbrances. And so encumbrances, okay, so first you have appropriations, and that's what you're planned to spend. And then when you want to spend some, then you encumber for it. And basically that's reserving it for you to spend. So as an example, if my budget department, if my department division of business of Friends University is allowed to spend $5,000 this year on travel, or not, we don't have any money for travel, but if we did, if we had $5,000 set aside for travel, then what would happen is we would have an appropriation of $5,000. And so it would show up as a journal entry. This would be money that is in my budget that I am allowed to spend. But there are 6 of us in my department. Jim Long is the chair. Sean Cash is an assistant chair, and so am I. Okay. And so Sean handles like outreachy kind of stuff, and I do all the operations. Okay. So I do all the schedules and all that kind of stuff. So Jim, Sean, Nicole, Jordan Kiefer teaches business law, business communications. Jenna Cantwell teaches a lot of management and leadership-y stuff. And then Neeland Brown. And so he's number 6, and he's teaching production and operations, a lot of global stuff, some more of the like leadership-y kind of stuff. So there's 6 of us. 6 of us. And so what happens is, so if our appropriation is $5,000, what if each of us look at our budget and be like, oh, there is $5,000 to spend, and we all spend $5,000. Like we all make our plane reservations and do all of our stuff, and we all spend 5. Then we just spent 5 times 6, $30,000. We only had 5 to spend. So what happens is before you can spend, you have to encumber for it. So I have to ask permission to spend some, and then I get approved, and then I can spend it. It's this extra level of accountability to make sure that we don't all spend the same money. I like it. I think it makes sense. I think it's a very logical thing to do to ensure that we are all accountable to each other. We can't overspend because it's not our money to spend. It's the citizens' money to spend. So we have to say, okay, we have $5,000 to spend. If I want to spend it, I have to ask permission. And that's how governmental and nonprofit institutions work. So as a nonprofit at Friends, this is exactly how we have to do it. When the budget is approved by the Board of Trustees, then they do a journal entry as of July 1 at the beginning of our academic year. And it says how much money we can spend. Before we can spend it, we encumber. When we encumber, it reserves the money so that no one else can spend it. And then we actually spend it. So, okay, so those are the budgetary accounts. These are all budgetary accounts. So they're going to have balances that are opposite to your regular balances. So in financial accounting, like in chapter 2 of financial accounting, we learn the rules of debits and credits, and we learned that ADE are debits, assets, dividends, and expenses. ADE are debits, assets, dividends, and expenses. So expenses have a normal debit balance. Revenues are a credit. So estimated revenues are going to be the opposite. So estimated revenues have a debit balance, and so do estimated OFS. But appropriations, so expenses have a debit balance. So this will be a credit balance. And same with estimated OFU. Okay. And then encumbrances will be a debit. But, so it's a debit when we encumber when we spend, we reverse it. So encumbrances in general should not have a balance at all after you spend. So you'll see the entries in this chapter. So I'm gonna actually show you the journal entries. But what happens is you encumber for it as a debit. And then when you spend the money, you reverse the encumbrance and you expend. So we'll do that over and over again. So you guys will get to see how that works. So, all right. So remember that in financial accounting, we have an accounting equation like assets equals liabilities plus owner's equity. And then the things under owner's equity are common stock and retained earnings. And then the red ones go into retained earnings. So if I were to do something like this in financial accounting, I would say, and I don't, this is a picture, by the way. I was having my husband print it for me earlier. So I could make my video. And I was like, oh, look, an accounting picture. And he's like, that's not a picture. And I was like, oh, in accounting, if there's words and arrows, I consider that a picture because that's as good as it gets for me because I have no artistic abilities. If we were to do this in financial accounting, we would say, well, assets equals liabilities plus owner's equity. And then off of owner's equity, we would branch off and have common stock and retained earnings. And then off of retained earnings, we would have revenues, expenses, and dividends because our red ones all roll into retained earnings. So it would be something like that. But here, let's go ahead and let's do this. So instead of assets equal liabilities plus owner's equity, we're going to call it fund balance. Okay, so we have assets equals liabilities plus fund balances. So instead of owner's equity, we have no owners because we're the government, right? So this is fund accounting. So we have our fund balances. Sometimes we call those net assets in financial accounting, and sometimes even in governmental accounting, we'll call them net assets. It's the difference between your assets and liabilities. So we all know that we can move liabilities to the other side of the equation and say assets minus liabilities equals fund balance. So for our fund balance account, if we want to break them down, we will have reserved fund balances and unreserved fund balances. Okay, so some of our fund balances are going to be reserved. And so what you're going to see there is like reserved for a specific purpose kind of stuff, like reserved for encumbrances will be in there and things like that. And we'll dig deeper into it in chapter 4. And then we have our unreserved fund balances. And so we will have our budgetary accounts will go here. That means they get closed. Okay, so these accounts are budgetary and operating, and they will get closed. Like we close our red ones, we will close our budgetary accounts. And then we have our operating accounts. So our budgetary accounts are the ones we just wrote on the previous page. We have estimated revenue, estimated OFS, appropriations, estimated OFU, and encumbrances. So those 5 budgetary accounts will all get closed, along with our operating accounts, which would be like our red ones, revenues, expenses, but we don't have dividends. So it would be like the red ones, but no D. But instead of calling them expenses, we're going to call them expenditures. So a lot of weirdness, but this is why people talk about fund accounting being something they don't truly understand. But if we reverse or if we relate it back to what we do understand, then it actually makes it a lot clearer. So our operating accounts are going to be our red ones. And so we're going to do revenues and expenditures, no dividends. Okay. Budgetary, the 5, estimated revenue, estimated OFS, appropriations, estimated OFU, and encumbrances. Okay. All right. So these are just some basic information about it. And so revenue versus OFS and expenditure versus OFU. OFS is basically operating, like transfers in and transfers out, or long-term grants and stuff. OFU is usually just transfers out. Revenues are going to be the basic things like taxes and things like that. We're going to use the modified accrual basis, which means it's measurable and available to pay current period obligations. So that's when we're going to record revenue. In financial accounting, we record revenue when it's earned. Okay. And so here it says measurable and available to pay for bills. So basically only the portion that we think we're actually going to receive. So expenditures and OFU, it's when incurred. And so as long as we're planning to pay for it within this operating cycle. So an appropriation is a legal authorization to spend money. And so an encumbrance is basically when we are reserving the money to be able to spend. And so if we sign a purchase order or something like that. So our let's go ahead and look a little bit more at when we classify our expenditures and appropriations, we can do it by fund. Like we could say that it's for the library, or we could do it by, or like for the general fund, or for a special revenue fund, or any of the PIPA CGRIBE stuff. Or we could say it's for a function, like a program like the library or whatever. Or we could do units or whatever. So let's go ahead and go into accounting for expenditures. So remember that before we can expend, we have to encumber, and before we can encumber, we have to do appropriations. So appropriations is the very first step. So before we actually spend any money at all, we have to have the legal adopted budget that the government signs off on. And so the board of trustees or the board of directors or the city council members sign off on the budget, and that's called appropriations. Okay, from there we have an amount we can spend, then we have to encumber, and then after we encumber, then we can expend. So these are the three steps: appropriations, encumbrances, and expenditures. So, and then under the revenues, it's just estimated revenues or OFU or OFS, I mean, and then actual revenue. So for our revenue account, we'll have estimated revenue. And that's estimated revenue or estimated OFS, and then regular revenue. So we basically have two steps. You can do estimated and then you receive it. Here, there's three steps: appropriate, encumber, expend. Here, we'll do estimated revenue and then we actually get it. All right. So this kind of relates to more like the tax class that you guys maybe just took the last 8 weeks. So ad valorem taxes is something that you guys talked about in chapter 1 of tax. And so ad valorem taxes means it's actually a tax on the value of the property. So if you have a $100,000 house and a $200,000 house next to each other, the $200,000 house is going to have more in property taxes because it's a more expensive house. So it's not like sales tax. Sales tax is a flat tax. So if I go to the grocery store and I spend $100 all on Doritos, and you go to the grocery store and you spend $100 all on ice cream, we're both going to pay 7.5%. because that's the tax rate in the city of Wichita. So that's called a flat tax. But an ad valorem tax is based on the value of the property. Okay, so a $100,000 house is going to pay less in tax than a $200,000 house. So ad valorem taxes are assessed on the value of the underlying property. Okay. So it's based on the value of the property. And so the same thing with cars. If you buy a new car, you'll notice your property taxes are higher than on the old car you used to have. And so those are called ad valorem. Ad valorem is probably a Latin word. I'm just guessing. I honestly don't know. Okay. So special assessments are taxes that are just on specific properties. So an example are, I remember when I first started looking for a house, like when I bought my first house back in 2005, I remember going around and I would look at these properties and it was advertised. They're like, these houses, no specials. And I was like, that's mean. Like, okay, fine. I know you don't want to like mark them down like at Walmart, but like, why are you saying that? And then I realized what specials actually were. So I don't want specials either. So specials are extra taxes on the property. Usually it's like when it's a newer housing development and they just put in sidewalks or whatever, that kind of stuff. And those taxes go to the property. So in my neighborhood, I live in Bel Air, and the property that we live on, I think I still have, I don't know, maybe 5 more years of specials. And so they are an extra $100, $150 a month. And so when you buy a lot, like of land, then maybe they come with $20,000 or $25,000 or $30,000 of the special taxes. And those are extra taxes. You can pay them off in full, like when you buy the property and just pay them off, or they'll spread them out over 15 years or whatever. And so I should have paid them off. That would have been smarter. So they can also come back in and assess extra specials. And so that is something that can happen. Like if they had to redo a bunch of stuff like street lights and things like that, they could give extra specials. And so I would be really mad if that happened. If I lived in a property and then all of a sudden they're like, we're giving you another $20,000 of extra taxes, I'll be like, no. So, all right. So licenses and permits, that would be like a liquor license or a license to have your dog tagged, marriage licenses, those kinds of things. So this is another source of revenue for the government. They can charge people for building permits and things like that. An intergovernmental revenue is usually transfers from one department to another, or grants or things like that that you receive from a higher level of government. So like if you get a grant from the state of Kansas. Charges for services, that would be like the water department or to get into the city pool. Fines and forfeits would be things like speeding tickets, or if you have to put like money down to have like at the water department and then you default and they keep your forfeit, you forfeit the money. And then you can have miscellaneous revenues. And so that would just be other weird stuff that doesn't fall into another category. All right, so finally, you can tell I'm excited because I love talking about journal entries. It took me a long time to get here, but really we're not doing much. So examples of budgetary journal entries. So in this, if the budget is approved, in this budget, it looks like we're budgeting $50,000 or $500,000 of revenue. And then the appropriations that we're planning to spend $450,000. So notice that estimated revenue is a debit and appropriations is a credit. So revenues are credits normally, but estimated revenues are debits because they're the opposite. And then we have fund balance, which is the difference between the revenues and the appropriations. Now, often your book will put the word budgetary in front of fund balance, and that's fine. So if you want to add the word budgetary in front of fund balance, that's fine. At the end, we reverse this entry exactly. So after we spend all of our money, all through the year. So this entry, notice it's dated the first day of the year. And so at the on the last day of the year, on 12/31, we would do an exact opposite of this, and then we would do the next year's budget the next year. So we're also going to have subsidiary accounts. And so we all know what subsidiary accounts are probably, but subsidiaries are a breakdown of a main account. So like an accounts receivable subsidiary would be like all of our individual customers. And you should be able to add up the subsidiaries to equal the control account, which would be accounts receivable. So in intermediate 2 is where I do the big project with the students. And so we do like a big giant comprehensive project. And when we do that, what we see is we have like accounts receivable 100,000, and then there's the customers. So maybe we have 20 customers that make up that balance of 100,000. Okay, so same thing with the government. We're going to do subsidiary entries in this chapter. Eventually we kind of drop off with them and we don't really do them anymore, but they always happen in real life. And so like anytime you use a estimated revenue account, you're going to need to break down where that revenue is coming from. Or if you use regular revenue, is it general? Is it fines and forfeits? Is it permits and licenses? Is it whatever? So you would specify like what kind. Same thing with appropriations. Like we have appropriations of 450,000. Well, what are they? So in my example, travel would be 5,000 of that. But would there be, I don't know, photocopying, and would there be wages, and would there be other stuff? So your subsidiary has to equal the total of the control account. So a subsidiary account by definition just gives a breakdown of the general control account. So in this example, if we took the estimated revenues, then we would look at these and we would add them up and we'd say 300 and 50 and 50 and 50 and 25 and 25 for a total of 500,000 of revenue. And then we have these expenditures, or like future expenditures, appropriations, 120, 150, 180. So 450,000 equals this 450,000. So if you're supposed to do the revenue subsidiary, then you'll break down the revenue. And if you do the appropriation subsidiary, you break this down. So notice that the debits and credits don't equal. The debits of this equal the debit of this. And then the credits of the subsidiary equal the credit here. So this is not a journal entry. This is the breakdown of all of the individual estimated revenues. So, all right. So the other kind of budgetary entry we're going to learn in this chapter is to do encumbrances. And so we need to kind of learn the idea of the encumbrances. So city clerk's office orders a new printer on January 2nd, which had a list price in the vendor catalog of $500. So the first thing we need to do is we need to, in the general fund, we would do this journal entry to show that we plan to spend $500. By the way, a lot of times I've just changed the font to white, so you can delete that, and I should have deleted it for you. And then you can type it in, or you can just turn it black and watch it. So you can just highlight this and turn it black to see what I have under there. So we have encumbrances. Now, encumbrances is a debit balance. And so we plan to spend $500, and our credit, all right, is reserve for encumbrances. So this is the entry we do every time we are encumbering for something. So we plan to spend $500, and so we need to notify the government that we're going to be spending a portion of the appropriations. So a new printer for the city clerk office, that would probably be under general government. Public safety is like the police department and stuff. So I think it's probably under general government. So it would be part of this $120,000 that we're planning to spend. So we said, okay, we are going to encumber for it. Encumbrances is a budgetary account. So remember our picture? Encumbrances is a budgetary account, so it will get closed. Reserve for encumbrances does not get closed. And so, but what happens is we reverse it out after we spend. So what will happen is the printer is received a couple of weeks later, and it included a shipping charge of $15. We weren't planning on that. We're like, oh man, I thought we were only spending $500. So what we have to do is we have to reverse the actual encumbrance at what we thought it was going to be, and then we expend. So the date on this entry would be 1/2, and then this entry would be 1/15. And so first step, reverse the encumbrance. So the entry we did before, we're going to do the exact reversal. And then we're going to spend the money. So when we spend the money, we'll do expenditures. And we spent $515. It didn't say we paid for it, so I'm assuming we're going to pay later. So if I paid, I'd use cash. If I was going to pay later in financial accounting, I would use accounts payable. But in the government, we use a voucher system, so we'll do voucher payable. I don't even know. So vouchers payable is just like accounts payable. It just means we're going to pay later. And we use a voucher system. So we're going to attach the appropriation along with the encumbrance with the invoice. And we're going to compare all those to make sure everything was approved. And then we actually pay it. So that's what vouchers payable means. All right. So just overall summary, this chapter focused almost exclusively on budgetary accounting. And so budgetary accounting means that we're going to record journal entries for the budget. We had 5 budgetary accounts. We had estimated revenue, estimated OFS, appropriations, estimated OFU, and encumbrances. Encumbrances they have a debit balance, but then they get reversed as soon as you spend the money. So we do an exact reversal when we spend, so we can do the expenditure. The estimated revenues, if you had estimated OFS, they would also be debited. If you had estimated OFU, they would be credited. The difference would go to budgetary fund balance, whether you have more or less. So the budgetary fund balance, if our estimated revenue would have been 400 and this was 450, then we would need a debit to budgetary fund balance. And so that happens if we need to build it up or need to bring it down based on what's happened in previous periods. And so, all right, so that's it. And so the last thing is we should probably take a look at our chapter 3 homework, and I'll give you a quick preview of that. And so as far as the homework goes, 1, 2, 3, 4, 5 tabs. And so they are a little bit more because I gave you parts of the book sometimes. And so I did some copying and pasting of parts of the book, but you guys are going to look at, so like, let me do a print preview of the whole thing. So looking at this, like there isn't that much to do on this page. There's the multiple choice. This one I went ahead and left the answer in for you. I don't know that those page numbers are right now that I say that, because I had to change the page numbers on one of the other ones, but it's okay. So here you're just going to describe or define what revenues, OFS, expenditures, and OFU are. There's some multiple choice. Then you're going to look through all of this, and it just says, do we have enough appropriations to make this purchase? And can we use a different balance instead? So then we have the CAFR. That's going to stop pretty soon. And so just so you know, like this doesn't go on forever. And like the CAFR homework is the hardest of the homework. So I'm sure you guys are a little bit annoyed by it. I've gotten some questions on it. I get it. But you guys are going to go through and answer some CAFR questions. And so on these, you guys notice you're just answering in the orange cells. And so you can tell that like when it's a little tiny box like this, it's probably just like a yes or no. I answered the last one for you. So you're just going to go through and it's just like list the 3 most important sources of general fund revenues and the most important source of revenue for each major governmental fund. So, okay, so next one, you're going to do some journal entries. And so this is the budgetary entry with estimated revenues and appropriations. This is the subsidiary of revenue and the subsidiary of appropriations. So like this one will be debits, this one will be credits. And so I gave you some hints down here. I think I removed one of the homework problems. So I think I had one more and I just deleted it. I think it was problem 324 maybe. So if it's not on this spreadsheet, you don't have to do it. By the way, I don't make these spreadsheets for my traditional students during the day when I teach this class. And so they would be very jealous of the fact that I'm making these spreadsheets for you. So they have to make their own. But I'm doing it for you because I'm kind of trying to direct like what you're working on and stuff. And so hopefully it's working. I'm not sure. So problem 323, I just said use page 108 of the text. And then problem 321, I went ahead and showed you that one. And then that's it. So the last 2 sheets, and so this again is just like some basic entry. So with the subsidiary. So I don't think your homework will be too bad. This stuff is extra review, and I had gone through this stuff when I was doing an exam over chapters 1 through 3, and so it's just a little bit more practice. And so I'm like, City of Becker approves their budget with estimated revenues of $1 million and appropriations of $1,050,000. Do the journal entry, and so it's just showing you like City of Becker orders a new computer, encumbrances reserve. City of Becker receives said computer, actual cost $1,005. So it's just some extra examples that you can use to kind of look through. It's the last page of the homework tabs. You don't have to do anything on it though. It's just extra information for you. So you are going to do 1, 2, 3, 4, 5 tabs of homework, but some of them are super easy. Like 323 shouldn't take too long. 321 is super quick. 320 is also super quick. I think that the CAFR one will be the longest. So, all right. I hope you guys are doing well. I'll make a video for overall everything for the week, and I'll have homework solution videos that I'll post tomorrow on Monday. So I hope you guys are doing well, and I will talk to you soon. Thank you.